Yo, what's going on, guys? Welcome back to once again another video. Today's video is going to be on the beloved Wyckoff. You know, the concept that everyone seems to have a problem with. I don't know why. Like, I'm gonna be honest, it's really simple. I feel like people really just complicate it, but it's really simple. But Wyckoff is literally just a way of identifying liquidity and market structure. That's literally it. Like all this UT, BC, ST, BS, you know, AR, sign of weakness, all this stuff that you're seeing, it's all just another way of identifying market structure, but it has just its specific phases. So let's start off with accumulation. So first thing first, read this. You don't need a course. I know like 99% of you guys that claim you guys don't know Wyckoff. It's because you don't read the stuff over here. This is all I've ever read. I've never done a Wyckoff course. Mentafx, he read this. Every single YouTuber that uses Wyckoff, they read this and backtested it. That's literally it. So let's look at the different phases. Well, there's phase 1, which is phase A. So this is the start of where the market starts to potentially start reversing towards the upside, or it starts the accumulation to go higher. Phase B is obviously more in depth, where it shows the second phase where the market clears the lows of the ST and the SC. Phase C, phase D, and phase E. But let's actually read all this. So PS, which means preliminary support. This is where substantial buying begins to provide pronounced support after a prolonged down move. So what does that mean? That means after a really big move towards the downside, a significant amount of buying pressure comes into the market and it starts creating support where the market goes up a bit. You know, price is trying to push higher. There's a lot of bullish momentum entering the market. Oh yeah, bullish momentum entering the market to go higher. But this is just the start of phase A. You know, they're your first sign. This is the market telling you that, all right, I might want to go higher now. Yeah, like I want to go higher, get ready. The selling climax, this is the most important part. The point at which widening spread and selling pressure usually climaxes, and heavier panicky selling by the public is being absorbed by larger professional interests at or near a bottom. So basically, if that's confusing, just selling climax mean that sells are out of the market and all the people that were selling are starting to close their positions for sells, and now people are opening buy side positions, buy side orders, and now you can see the immense of buying pressure is starting to add up, and the movement is slowly switching towards the upside. So you're going to notice how before the markdown was just simply the market pushing down one specific way, non-volatile. But as soon as the market reached at this point, the selling climax is where the market decided to actually move up, right? And come in with that bullish momentum that wasn't there before. Now, the automatic rally, which occurs because intense selling pressure has greatly diminished, meaning sells are finished, and a wave of buying easily pushes price up. This is further fueled by short covering. The high of this rally will help define the upper boundary of an accumulation. So the automatic rally, all it really is the market just making that first push up, that first small little expansion up, and most of the time it's gonna be just underneath the PS. This is an accumulation setup, so just underneath the PS. So I'm assuming in my own eyes, with the way I see it, is that the automatic rally is going back up to test any little bit of supply, if there was any supply left at the preliminary support. Because sometimes you'll see at the preliminary support, you're going to notice that there's like an order block or something there, and the automatic rally usually goes up to test that order block. Now the secondary test, in which price revisits the area of the selling climax to test demand balance at these levels. If a bottom is too confirmed, volume and price spread should be significantly diminished as the market approaches support in the area of the selling climax. It is common to have multiple STs after a selling climax. So an ST, which is a secondary test, is basically just retesting any little bit of demand where the selling climax first happened. So if you see, for example, let's open the paint thing, right? So let's say the market was selling off, boom, and then right over here we have our selling climax. The market just decided to go up. Let's say this is the PS, right here, this is that PS, and this is my selling climax right here. Basically, let's assume that the market left an order block inside an area right here. an OB right here that the market has to come back to retest. The automatic rally, or not the automatic rally, sorry, the secondary test is literally just testing that order block or that demand block inside of this this area. So in this case, this is my bad. In this case, this is our secondary test, and obviously this is the automatic rally, which is just testing any little bit of supply inside of this area, and then from after testing that supply, the market goes down to test any little bit of demand inside the selling climax. So yeah, and then you have the secondary test in phase B. So the secondary test in phase B, let's go down up to here, was it? Okay, for some reason it doesn't have a explanation on the secondary test in phase B. Let me just quickly scroll down here. Yeah, it doesn't, but I'll explain that to you, no problem. So Wyckoff is initially just a manipulation of the lows. Notice how every single time the market creates a low, right here, selling climax, secondary test, the market goes below the ST and the SC, and then there's the spring which goes below the ST. So it's like a 3-point markdown where the market creates 3 lows, 1, 2, 3, and then it goes up. So I'll give you guys a good example of what I mean by that. So market is selling off, and then we have our selling climax, automatic rally, secondary test, and then the market goes up, and then here we have the secondary test in phase B. So anyone who bought over here or bought over here, initially what's happening is the market is just stopping them out. So this is initially like a type of liquidity grab. So the secondary test is the type of liquidity grab where the market is just manipulating the lows over here and the lows over here. Now notice after the secondary test in phase B, there is a spring right here. So you have the ST in phase B, and then the spring. So these are 3 markdowns. 1, 2, 3. 3 times the market is breaking the lows. So not bad about that. So after the STB, let me open this again. You have the spring. So after the STB, you have the spring. So right here, the market is gonna start to go up a bit. It's gonna create some type of sign of strength. So the sign of strength is basically just the market market showing you that there's a lot of bullish pressure. Right here in phase B, you see that there's not the sign of strength, but most of the time the SOS will not happen in phase D. It tends to happen in like random time. So whenever the market breaks above the automatic rally or the high above the automatic rally, consider that to be your sign of strength, and that sign of strength is basically your confirmation that the market is getting ready to go higher. So right here we have our sign of strength. Let's just assume that this is the sign of strength. Now what the market is going to do is going to come back down, and it's going to manipulate the STB. So this is the last point. This is called the spring. Once the market creates that spring, notice how we had 3 markdowns. 1 where we cleared the selling climax, 2 where we cleared the secondary test, and 3 where we cleared the secondary test in phase B. So the spring is initially that last point where the market takes out the lows before going higher. So let's assume this is our spring, 1, 2, 3. And now the market will go up, and most of the time there's going to be an order block inside of the spring. And now that's when the market is going to come back to test that spring, and that's when the market is going to go up to finish its Wyckoff accumulation. Most of the time it's going to look like something like this, something like that. So that's initially just the accumulation schematic of Wyckoff. Now sometimes people get confused about the LPS, the BU, the LPS, and the sign of strength. So that's what I'll be explaining as well. So the LPS is basically, let me delete all this. So the LPS is basically the last point of support. So selling climax, automatic rally, secondary test in phase B, spring, right? And so this is the spring. So we have our selling climax, automatic rally, testing any little bit of supply to the left, secondary test in phase B, and then we have our spring right here. Now someone asked the question, okay, how do I actually enter this? Because most of the time after the spring, the market doesn't test it that quickly. It sometimes just goes up like that. How do you enter that? Well, this is where you want to look for your sign of strength. So let's say after the spring, you want to see immense buying pressure start. You want to see the market just completely go up. And once you see the market break structure towards the left, like for example right here, we break structure, call this your BOS. Once you see the market break structure, that's when you want to start potentially looking for your buy side opportunity. So then the question comes, how do I enter by the LPS? Because everyone's saying, oh, enter at the LPS. Well, the last point of support is literally just the order block that caused this big move. So most of the time you're gonna see the last point of support be in the middle of this big move. So what I usually do is I take my Fibonacci from the spring to wherever the market decided to start retracing, so from here to here, and the 50% is usually where the LPS is going to be formed. So right here, actually this is where the LPS is. Now this is when the market is going to come back down. Let's say the OB is right here. This is our order block. My bad, order block. So my bad for my horrible handwriting, but yeah, so that's our order block. So at this point, all you would do is you'd wait for price to come inside of your order block, which would be our LPS. And sometimes there's an order block below it as well. You can use both of those levels if one doesn't work out. Just make sure you only risk about 1% each zone. So at this point, this is where you can potentially start looking for your buy side entries. So when the market comes to your LPS, you can either enter right away with a limit, or you can wait for rejection and proper confirmation and then take the trade. And most of the times the LPS is the best time to enter because there's more confirmation. Because the sign of strength, which is this right over here, the sign of strength, what this tells you is that the market is getting ready to go higher. And the reason this tells you this is because we're breaking structure now. Right here, you can see the sign of strength, we broke past the automatic rally, we're breaking structure, we're getting ready to go higher. So that's an accumulation schematic. The second one is an accumulation schematic 2, where there is no spring. There's just an LPS after the ST and B, and the market goes up. Same concept, just make sure you're reading all of this. That's the most important part. Read all this free information. Now, this is the distribution schematic. Same concept, just flipped over. So distribution happens at the top of an uptrend when the market is getting ready to sell off, reverse. So the PSY, the preliminary supply, is the opposite of the PS. Preliminary supply is when a lot of selling contracts get entered into the market. So this is when the market is pretty vulnerable for sellers, where the buy side movement towards the upside is so overextended and so tired out that sellers start coming into the market, and then you'll see the market start selling off a bit. And then after that sell-off, you're going to see the buyer's climax, which is the exact same as the seller's climax, but instead of buyers, it's going to be sellers. So this is where buyers are finished, they don't buy anymore, and sellers enter the market. Right? Notice how this is the same. Selling climax, buyer's climax, just different contracts. So after the BC, you have the automatic rally. The automatic rally is the market just going down to test any little bit of demand inside of the PSY. Now from that automatic rally, you're going to see a secondary test of the market testing any little bit of supply inside of the buyer's climax. So you might see an order block there, and that's when the market will test that order block. And then after the secondary test, we're in phase B, where the market will give you a sign of weakness. So the sign of weakness is basically just the market breaking the previous AR, breaking the previous low, and creating new low. So this is indication that the market is getting ready to go lower. It's getting ready. There's a lot of sellers in the market. There's the momentum is there, the contracts are there. All that's really left is for the market to finish the schematic, and then we'll go lower. Now after the ST, you have the UT, which is the upper thrust. The upper thrust is the same thing as the ST in phase B. It's just clearing the liquidity of the people who entered at the ST and the BC. So you most likely you're going to see the UT close above the BC and ST, and after the UT, you're going to see a small little retracement back down. And then after that, you're going to see the UTAD. So the UTAD is the upper thrust after distribution, which is the exact same as the spring, but it's just called different. It's just, the opposite. So the upper thrust after distribution is just clearing the lows, or clearing the highs rather, of the UT and the BC and the ST. And that's when the market is in its final stages to get ready to sell off. And when the market does that, it's going to create an LPSY, sign of weakness, and then the market is going to sell off. So I'll show you guys a decent example on GPUSD. Let me go to the 15-minute time frame. So let's go right here, just over here, and let's look at the distribution schematic. Now remember, cause and effect. Let's go to the 4-hour time frame, and let's look at why the market is selling off over here. The cause of this, we need to find the cause of this. So the cause is obviously towards the left, and it is because there is an order block right over here. We can see that there's this last down candle, this last up candle before the move down. The market basically comes to test that OB right here. Now, if we check the 15-minute time frame before it actually tested it, you can see after it tested it, the market ended up selling off. Immense power of sellers came into the market. So now let's see if we can see any distribution schematic inside of this area. We go to the 5-minute time frame. And in this case, I don't see any distribution happening. But if you look a little bit towards the left and you go on and forward, you can see right over here, there's amazing distribution. Let's look at this. So the PSY, the preliminary supply, where large interest begins to unload shares. So where sellers decide to start selling, the first area where sellers decide to start selling. In this case, this would be the PSY. So we have our PSY right here, and then let's look for the buyer's climax. So the market goes down and the buyer's climax is right here. So the BC this is where immense selling pressure starts to begin, and then we have the automatic rally to do what? To retest any little bit of supply where the market sold off right over here. So you can see how this is the PS, right? When we check the line chart, you can see that this is the PS, and I'm assuming that there was some little bit of demand inside of this area. So the market moved down to test any little bit of demand inside this area before going higher. So it took out the demand, and then what it ended up doing is it came back up to give a secondary test right over here. My bad. So we have the secondary test where the market comes back up to test the area where the BC was. If you check the 15-minute time frame, you can technically say this is your BC as well. It's like one whole big area, but the market is initially just testing any little bit of supply left inside of the BC. Now what's next after? You're supposed to see a sign of weakness. In this case, we didn't get the sign of weakness. The market didn't give you a sign of weakness, and that's okay. It does lower the probability from like a 99% chance of the Wyckoff playing off to like an 80% chance, but overall the Wyckoff is still proper. So after the secondary test, you're obviously expecting the market to create a UT, which is the upper thrust, clearing what? Clearing the highs of the BC and the ST. So anyone who's entering over here, they create liquidity above and liquidity above over here as well. And that's what ended up happening right here. The market created the UT. So the upper thrust happened, and everyone who entered at BC and ST, they just got stopped out. They're out of the markets now. Now if we look a little bit towards the left, what we're supposed to expect after the UT is a small retracement and then the UTAD right after. And what do we have? Well, we have the small retracement, and right after that, you can see that the candle closed above the UT. So this is considered as our UTAD right over here. Now, notice how at the lows there's liquidity now. There is so much, schematic happening that it created a bunch of liquidity of the lows now. So technically speaking, we have a reason why the market needs to come lower now. Let me just quickly do this. Now we have a reason why the market needs to go lower, because there's liquidity here and the market is attracted towards liquidity. So after the UTAD, which has happened right over here, you could have had two possible entries. Let's go right here. You could have had two possible entries. So after the UTAD, you could have looked at the OB. So either this OB right here, this last up candle before the move down. And you can check the 4-minute, 3-minute, 2-minute, 1 minute. Alright, I guess I can't use the 1 minute, too far. Alright, my bad. I guess I can't use the 1 minute. But so after the UTAD happened, what we can notice is that the price came back up to do what? To give a test of that UTAD. So where the UTAD happened, the upper thrust after distribution, the market came back up to test any order blocks inside of those areas. So right here, we can see that we have this last up candle before the move down. So what I would do is I take my tool, get this black really quick, right? And I would just have my entry just over here. I'm entering on the test of the upper thrust after distribution, and my stop loss is just going to be the high of the candle. So I can either put my stop loss right over here for 7.5 pips, but that's pretty unrealistic. Mostly you'll get stopped out because of spread. So I would just put my stop loss right here for 13 pips, and my TP would literally just go at the lows right over here. So if I was thinking about holding this long term, I would definitely go for a better target, like maybe down here, which would be a decent 6-to-1 risk to reward ratio. And if I am swinging this trade, then obviously we would be looking to target just the next significant low that's untested. significant low that's untested. Now notice that the higher time frame is also switching structure. If you check the 15-minute time frame, you can see that we're starting to break structure on the higher time frame. So right here we created a high, higher low, higher high, right? And we also have micro structure forming inside of this area right here. So right here we can kind of see that the market closed below this area right here. So we do have a breaker structure indicating that the market does want to go lower now. So after we do get our entry filled right over here, this is hindsight, by the way. I'm not taking credit for this, completely hindsight, just showing you guys how to use Wyckoff. So after you get your entry filled, you can notice that boom, price automatically goes down after filling in your entry. Now we have our sign of weakness as well, which is right here. So the sign of weakness is where the market goes below all the schematics. It's basically clearing the liquidity and breaking structure. We broke all this structure over here. Now the market is clearing liquidity. So I'm just going to delete this entire thing right here, just make it a little bit more cleaner, and boom, now the market is just, you guys just can see what the market did. It just completely sold off right here. Yeah, so you can see from here it just completely sold off, moved all the way down up to like this point right here, or up to this point right here, which is 500 pips, which is crazy that this 5-minute Wyckoff schematic could have caught you this huge 500 pip move just by understanding structure and understanding how Wyckoff really works. Because that's one major thing that people don't know. They don't understand how Wyckoff works, and it's because they don't like to read. If you just read what Wyckoff is right over here, all this information over here, then you would understand how it actually works. Like, understand the phases, and then don't just do that, but also make sure you're back testing what you're reading. So I'll give you guys a good example of how Wyckoff works. Let's go to Euro USD. This was just an example I was doing for my course that I'm releasing, but yeah. So let's delete everything right here. Remember, accumulation happens at the bottom of a downtrend, getting ready to go up, and distribution happens at the top of an uptrend, getting ready to go down. Right here, you can see the market push down, and we can already see some of the schematic right here. So PS, where do we have the PS? Right here. I'm not going to go too deep into it, but right here, PS. After the PS, what do you have? You have the selling climax. You have the automatic rally. After the automatic rally, you have the secondary test. After the secondary test, you have the secondary test in phase B. You can see that the price closed below right here. This wick went below, clearing the liquidity. Now after the ST and B, the market pushed up, giving you a sign of strength right here, breaking previous structure. So this is considered a BOS. So let me just give you a BOS top right here, boom. And this is also considered as our SOS because we just broke above this here. But actually no, sorry, this wouldn't be your SOS. The SOS is the markup after breaking the automatic rally. So boom, and after the STB, the market comes back to test any order blocks here, and the market just completely goes up. Now after, so this is an accumulation schematic. Now right here, we can see that the market distributed right here at the top of the uptrend. Right here, we can see that the market consolidated for a bit, distribution, and let's zoom into this consolidation and see what price did. Do we have the I'm not going to go on the 15 minutes to actually do the schematic. I'm just going to look at this theoretically. So like I said, on distribution, it is a 1 2 3. It's a 3 markdown distribution. So we have our first BC 1, and then what do we have? We have the ST 2, and then we have the UT 3. So we have the 3 markdown markup distribution, and then after that the market completely sells down. Now we started breaking structure towards the left right over here. The market broke structure right here, BOS. We break structure, and then last second the market comes back to do what? To test that last OB, which would be either our UT or our LPS. I'm not going to go into this on the 15-minute time frame. It's too deep. I doubt I would even be able to do that. But you can see that the market came back up to test this last order block right over here. And after it tested that OB to the pip, you can see that it created its sign of weakness and just completely sold off. Depending on where you would target, I would probably just target the lows right over here. Stop loss would be somewhere, whatever. And yeah, so that's how Wyckoff really works. It's so easy to spot. Now, one thing that I just want to say it's not like you can see Wyckoff just by looking at this. Just off of this little bit of information, I don't know that Wyckoff is happening. I usually only find out that Wyckoff is happening after I see, like, literally right over here at this point. Let's say the market didn't do that. Right over here, this is when I would see that Wyckoff is about to play out. That's when. I don't see Wyckoff happening like when I see one move like this. You have to have patience. So that's basically how I see Wyckoff, how I implement it in my trading. If you guys like this video, please leave a like, comment, share, subscribe. Any questions, please leave a comment below. Thank you and take care.